In just 23 seconds, $8.7 billion disappeared from global markets. I didn't raise my hand. I didn't nod. I simply said two words that changed everything. The cameras caught it all. Wall Street froze. Trading floors went silent. What did I reveal about BlackRock that made the most powerful financial institution in the world lose control? What did Larry Fink see in my eyes that made him realize his empire was built on quicksand? This isn't just another story about monetary policy. This is about the moment I realized that BlackRock believed they could dictate terms to the Federal Reserve itself. They were wrong. The morning of December 3rd, 2024 started like any other Tuesday, but at 7:23 a.m., something arrived that would change everything, a sealed envelope hand-delivered by BlackRock's chief operating officer. Inside was what they called the Stability Framework, an $8.7 billion proposal that would fundamentally alter how the Federal Reserve manages liquidity during financial stress. I opened the document expecting the usual corporate request. Instead, I found something that made my blood run cold. BlackRock wasn't asking for permission. They were presenting an ultimatum. The proposal was elegant in its audacity. BlackRock wanted the Federal Reserve to guarantee that during any future financial crisis, their assets would receive priority protection through emergency lending facilities. In exchange, they would provide market stability services worth $8.7 billion. They presented it as a partnership. I saw it for what it really was, a hostile takeover of monetary policy by private capital. At 9:15 a.m., Larry Fink himself called my direct line. No assistance, no scheduling, just the CEO of the world's largest asset manager demanding an immediate meeting. His voice carried that familiar Wall Street arrogance, the tone of a man who'd never been refused anything in his life. Jerome, we need to discuss the framework. Today. I told him I'd review their proposal through appropriate channels. The silence lasted exactly 4.7 seconds. I could almost hear his blood pressure rising through the phone when he spoke again. His tone had shifted from demand to barely concealed threat. You should understand, Jerome, that this framework isn't just beneficial for BlackRock. It's essential for market stability. Without it, the next crisis could be far worse than 2008. The implicit threat was unmistakable. Support their plan or face the consequences. That afternoon, I convened an emergency meeting of the Federal Open Market Committee. I placed BlackRock's proposal on the conference table, like evidence in a criminal trial. The reaction was immediate. Board member Christopher Waller actually laughed out loud. They want us to codify too big to fail for asset managers. This isn't partnership. This is subordination. Governor Lisa Cook pointed out something even more troubling. The proposal included language that would give BlackRock effective veto power over certain Federal Reserve policy decisions during market stress. Governor Philip Jefferson identified the core constitutional problem. What BlackRock was proposing would create a private institution with quasi-governmental powers but no public accountability. Meanwhile, financial media outlets were already reporting that BlackRock had presented a major proposal to the Federal Reserve. Markets were reacting. The Dow Jones jumped 340 points based on speculation about new public-private cooperation. Bloomberg reported BlackRock stocks surging. None of them understood what was really happening. They thought they were witnessing financial innovation. What they were actually seeing was an attempted coup against monetary policy independence. By 3:30 p.m., Larry Fink was in our building. He arrived with BlackRock's chief risk officer, their head of government relations, and 3 attorneys. Fink entered like a man accustomed to being the smartest person in the room, tall, silver-haired, wearing a navy suit that probably cost more than most Americans make in a month. The opening presentation lasted exactly 17 minutes. They painted a picture of unprecedented global financial complexity. Traditional central banking tools, they argued, were insufficient for modern market realities. Asset managers like BlackRock had become critical infrastructure for the global financial system. When Fink finished, the room fell silent. I let the silence stretch until it became uncomfortable. Then I asked the question that would define everything. Mr. Fink, who elected you? His expression shifted almost imperceptibly. The confident smile remained, but something flickered behind his eyes. For the first time in decades, Larry Fink looked uncertain. His perfectly manicured fingers drummed, once against the mahogany table. I'm not sure I understand your question, Chairman Powell. But he understood perfectly. His entire worldview was cracking in real time. It's quite simple. The Federal Reserve derives its authority from Congress, which derives its authority from the American people. You're asking us to share that authority with an institution that serves private investors. So I'm asking, who elected you to make monetary policy for the United States? The room's temperature seemed to drop several degrees. Chairman Powell, this isn't about election. This is about expertise and capability. BlackRock manages $10 trillion in assets. We have real-time visibility into global market flows that no central bank possesses. I opened the folder containing my response to their proposal. Mr. Fink, let me tell you what I see. I see a private company asking for guaranteed bailouts during crises. I see an institution seeking government backing for its investment decisions without government oversight. I see a proposal that would privatize profits while socializing losses. His jaw tightened. That's a mischaracterization, Chairman. We're offering expertise to strengthen the financial system. No, Mr. Fink, you're offering to help us manage problems that your industry creates in exchange for insurance against the consequences of your own risk-taking. That's not partnership, that's moral hazard institutionalized at the highest level of government. The silence that followed lasted 23 seconds. In those 23 seconds, Larry Fink realized that the Federal Reserve wasn't going to capitulate. In those 23 seconds, the most powerful asset manager in the world discovered that some institutions still believed in constitutional responsibilities more than private profit. What happened next unfolded with mechanical precision. Fink's phone buzzed, then buzzed again. Through the conference room windows, I could see Federal Reserve staff answering phones with increasing urgency. At 4:17 p.m., exactly 23 seconds after my rejection became clear, the first automated trading systems began responding to leaked information from our meeting. BlackRock's stock price dropped 3.2% in the first minute. Somewhere in Manhattan, alarms were screaming on trading desks. The financial sector, ETF, fell 2.1% as algorithmic traders interpreted Federal Reserve resistance as negative. Phone calls were flooding BlackRock's crisis management team. The VIX volatility index spiked 11 points, but the real crash began when high-frequency trading algorithms misinterpreted the movements as signals of broader financial instability. As BlackRock's stock continued falling, automated systems began selling other financial stocks. Bank of America dropped 4.3%. Goldman Sachs fell 3.9%. JP Morgan Chase declined 4.7%. The S&P 500 lost 2.8% in the final hour, wiping out $1.2 trillion in market value. The Nasdaq fell 3.4%. International markets followed. London's FTSE dropped 2.1%. Frankfurt's DAX fell 2.6%. Financial media scrambled to explain the crash. But none of them had the real story. They didn't understand that, in rejecting BlackRock's proposal, I had demonstrated that the Federal Reserve would not allow private interests to capture monetary policy. At 4:52 p.m., with markets closed and damage tallied, Fink made one final attempt. Chairman Powell, perhaps we could discuss modifications to the framework. I stood up, signaling the meeting's end. Mr. Fink, our goal isn't mutual. Your goal is protecting BlackRock's interests during crises. Our goal is protecting the American people's interests at all times. Those goals are incompatible. He gathered his materials slowly, processing the magnitude of his failure. As his delegation prepared to leave, I offered one final observation. Mr. Fink, BlackRock has grown powerful by managing other people's money wisely, but that success doesn't qualify you to manage monetary policy for 330 million Americans. The conference room door closed behind them at exactly 5:03 p.m. The evening brought calls from financial journalists and international central bankers seeking to understand the day's volatility. I authorized a brief statement confirming we had met with BlackRock but would not pursue their proposal. That night, Asian markets opened with significant volatility. The Nikkei fell 2.7%, the Hang Seng dropped 3.1%. European markets followed suit. Looking back on that December afternoon, I realized that the 23 seconds of silence represented more than just a pause. They represented a moment when American democracy proved stronger than private power, when constitutional responsibility prevailed over corporate influence. Larry Fink had entered believing that BlackRock's size made them indispensable partners. He left understanding that in a constitutional democracy, no private institution is too big to be told no. The $8.7 billion they offered paled in comparison to the independence that such a partnership would have cost. Wall Street's crash wasn't caused by economic uncertainty. It was caused by the certainty that the Federal Reserve would continue serving the American people rather than Wall Street's preferences. The lesson remains relevant for anyone who believes that money always wins in Washington. Sometimes constitutional responsibility prevails over corporate influence. The Federal Reserve exists to serve the American people, not to accommodate private institutions. That's a principle worth defending, even when it costs $1.2 trillion in market value over 23 seconds, because some things matter more than stock prices. Democracy is one of them.